Monthly payments have become a cornerstone of modern consumer culture, creating an illusion of affordability that many embrace without question. This payment structure has been normalized in our everyday lives, from car loans to subscription services, making it seem like a natural way to manage expenses. However, beneath this surface lies a complex web of implications that often go unnoticed. By breaking down costs into smaller, manageable installments, consumers may overlook the total financial burden they are assuming. This normalization can lead to a false sense of security, where individuals feel empowered to make purchases they might not afford outright. As we delve deeper into the psychology behind this phenomenon, we will uncover how it shapes our financial decisions and influences our perception of value, ultimately impacting our long-term financial health in ways we may not fully comprehend. Consumers often evaluate affordability through the lens of monthly payments instead of considering the total cost of a purchase. This focus on smaller, manageable amounts can create a misleading sense of financial comfort. For instance, when faced with a vehicle priced at $20,000, consumers may feel more at ease thinking about a payment plan of $400 per month rather than the total price. This shift in attention can significantly impact financial decision-making, leading individuals to commit to expenses that may not align with their long-term financial health. As a result, people might overlook the cumulative costs associated with these payments, which can lead to financial strain over time. By concentrating on monthly figures, consumers may inadvertently prioritize short-term affordability over long-term financial stability, ultimately influencing their spending habits and overall financial well-being. Breaking down large costs into smaller, manageable monthly payments has profound psychological effects on consumers. This division significantly reduces emotional resistance, making spending feel less burdensome. When faced with a hefty price tag, individuals often experience anxiety and hesitation. However, when that same amount is spread over several months, it transforms into a more palatable figure. This shift allows consumers to detach from the total cost, focusing instead on the smaller, more digestible monthly obligation. Consequently, the perceived risk of spending diminishes, leading to increased willingness to make purchases. This psychological trick not only eases financial strain, but also fosters a sense of control over expenses. As consumers embrace this payment structure, they may overlook the long-term implications, reinforcing a cycle of spending that feels manageable in the moment, yet accumulates significant costs over time. Monthly payment structures significantly broaden the range of individuals who can afford various purchases. By breaking down larger costs into smaller, manageable installments, more consumers find themselves willing to agree to spending. This accessibility leads to a surge in demand for products and services, as people who may have previously felt excluded from the market can now participate. Interestingly, this increase in demand does not result in a decrease in overall costs. Businesses often maintain their pricing, capitalizing on the expanded customer base without adjusting their profit margins. Consequently, while more individuals engage in spending, the financial landscape remains unchanged in terms of total expenses. This dynamic creates a paradox where affordability feels enhanced, yet the underlying costs persist, prompting consumers to navigate a complex web of financial commitments that may not be immediately apparent. Extended payment timelines can significantly affect total costs, often leading to a gradual accumulation of expenses that may not be immediately apparent. When consumers commit to longer payment periods, they may feel a sense of relief due to lower monthly obligations. However, this comfort can mask the reality of increased total expenditures over time. As payments stretch out, interest and fees can compound, leading to a scenario where individuals pay much more than the initial price tag suggests. This subtle yet powerful shift in financial perception means that consumers may overlook the long-term implications of their choices. Instead of focusing on the immediate affordability of monthly payments, it is crucial to consider how these extended timelines can lead to a heavier financial burden in the future. Ultimately, this accumulation of costs can impact overall financial health and decision-making in profound ways. As recurring payments become a routine part of our financial landscape, they seamlessly blend into our daily lives, creating a constant hum of financial obligations. This background noise often goes unnoticed, accumulating silently over time. Many individuals may not realize how these payments, whether for subscriptions, loans, or services, shape their financial reality. The convenience of automatic billing fosters a sense of ease, masking the true extent of our commitments. Each month, as payments are deducted, we may feel a fleeting sense of control. However, this normalization can lead to complacency, making it easy to overlook the cumulative impact on our finances. Over time, these obligations can create a false sense of security as the total amount spent becomes obscured. By understanding this phenomenon, we can begin to recognize the hidden layers of our financial lives and the implications of our spending habits. Monthly payment structures offer significant structural advantages for both systems and institutions, primarily through the facilitation of predictable cash flow. This predictability allows organizations to manage their finances more effectively, ensuring a steady stream of revenue that can be forecasted accurately. With consistent cash inflow, institutions can plan for future investments, operational expenses, and growth initiatives without the uncertainty that comes with lump sum payments. Additionally, monthly payments can enhance customer retention as they create ongoing relationships between consumers and businesses. This continuity fosters loyalty and encourages repeat transactions, further stabilizing revenue streams. Furthermore, the ability to offer products and services through monthly payments can expand market reach, enabling institutions to cater to a broader audience. By lowering the barrier to entry, more individuals can engage with offerings, ultimately benefiting both consumers and providers through enhanced accessibility and sustained financial engagement. The allure of monthly payments often masks deeper emotional trade-offs between convenience and clarity. While the comfort of spreading costs over time can feel like a smart financial strategy, it can also create a deceptive sense of progress. Individuals may believe they are making headway in their financial commitments, yet they remain tethered to a cycle of payments that lacks true ownership. This emotional comfort can lead to complacency, where the clarity of total costs fades into the background noise of monthly obligations. As consumers prioritize immediate gratification and convenience, they may overlook the long-term implications of their financial choices. The illusion of affordability can foster a disconnect from the reality of debt accumulation, leaving individuals feeling secure while unknowingly compromising their financial independence. Ultimately, the ease of monthly payments can obscure the true nature of financial responsibility, leading to a precarious balance between comfort and clarity. The persistence of monthly payment structures across various industries can be attributed to their inherent efficiency and scalability. These payment models allow businesses to attract a broader customer base by making products and services more accessible. By breaking down costs into smaller, manageable amounts, companies can appeal to consumers who may otherwise shy away from larger, one-time expenditures. This approach not only enhances sales, but also fosters customer loyalty, as individuals feel less financial strain when committing to smaller payments. Furthermore, the scalability of these structures means that businesses can easily adjust their offerings to meet market demands. As more industries adopt this model, it becomes increasingly normalized, creating a cycle where consumers expect and prefer monthly payments. This cycle perpetuates the dominance of such structures, reinforcing their role in shaping consumer behavior and financial landscapes across the board. As we conclude, it is essential to reframe our understanding of monthly payments. These payment structures serve as a lens that significantly alters consumer perception. Rather than viewing costs as a whole, individuals often focus on manageable monthly amounts, creating an illusion of affordability. This shift in perspective can obscure the true financial implications of our choices. By encouraging awareness of these structures, we invite consumers to reflect on how they influence spending habits and financial decisions. It is not about offering direct advice, but rather fostering a deeper understanding of the mechanisms at play. Recognizing the impact of monthly payments can empower individuals to navigate their financial landscapes with greater clarity. As we move forward, let us remain mindful of how these seemingly simple arrangements shape our financial realities and decisions over time. As we explore the concept of monthly payments, imagine price tags splitting into smaller amounts, each segment representing a manageable piece of the whole. This visual metaphor illustrates how large costs can be perceived as less daunting when divided. Picture a calendar, with each month marked by recurring payments, creating a cycle that feels routine and familiar. This steady rhythm reinforces the normalization of these financial obligations in our lives. As the visuals unfold, maintain a calm and steady pace, allowing viewers to absorb the implications of these structures. The splitting price tags and cyclical calendars serve as reminders of how easily we adapt to these payment methods, often overlooking the total costs. Each visual emphasizes the gradual acceptance of monthly payments, subtly shaping our financial decisions and behaviors over time, inviting reflection on their deeper significance. As we conclude our exploration of monthly payment structures, it is essential to reflect on their deeper implications. Consider how these payment methods shape not only our purchasing behavior, but also our long-term financial outcomes. They create a sense of ease, allowing us to acquire goods and services without immediate financial strain. However, this convenience can mask the reality of accumulating debt and the true cost of our choices. By fostering an awareness of these structures, we empower ourselves to make informed decisions rather than impulsive ones. It is crucial to recognize the subtle ways in which payment plans influence our lives, often leading us to prioritize short-term satisfaction over long-term financial health. Let us take a moment to contemplate how these seemingly simple arrangements can profoundly affect our financial journeys, encouraging a more mindful approach to spending and saving in our everyday lives.